Hi Fools, and welcome to a Motley Fool video with me, Sonia, and today I'm joined by Senior Analyst Nate Weisshaar. Welcome, Nate.
Glad to be here.
Now, Nate, something that's caught my attention this week is company debt. And the question I have for you, is it good for a company to have debt on its books?
Generally, the answer is no, but it's not quite as black and white as that.
Okay.
Not having debt on your books gives a company significant flexibility.
Yeah.
In good times, no one really cares, but it's when times get tough and no one really knows when that's going to happen. But when times get tough, sales will slow down and your debt obligations will remain the same. And so as sales slow, your costs as a percentage of those sales increases, which increases the risk that the company will, the profits will fall more than they should, or even the company goes out of business.
Okay, so it looks like there is good debt and there's bad debt. So can you give us some examples of some good debt?
Well, good debt would be a lot of the debt that we're seeing companies issue now is extremely cheap. Historically low interest rates mean that it's really easy for high-quality companies to get money for a very low rate. Companies like Rio Tinto and Shell, they both issued multi-billion pound bonds recently, and between the two of them, they're paying rates somewhere between 1% and 4% for 5 to 20-year bonds, which is very attractive. And this cash is going to be used to pay for investment in new mines and new drills or new wells. So it's essentially investing in the future growth of the company.
That sounds great. So bad debt, any examples of that?
Well, bad debt is anything that management uses the cash for things that don't grow the company. Sometimes this isn't obvious, but a recent example would be Premier Foods, which invested in a lot of new brands to put in its portfolio of products, and found out that those brands weren't as profitable as they thought they were going to be, and so they had a bigger portfolio, but they also had a big wad of debt. When those brands didn't make the sales that they thought they were going to make, the company's profits collapsed, the share price collapsed, and the CEO got fired. Now the company's selling off those assets that they just bought in order to pay down this debt and try and re-establish themselves. Brilliant.
Well, thank you for those examples, Nate. There is obviously good debt and bad debt. I guess the real question is whether or not a company can really afford to pay those debts. So I hope that's helped you. Thanks for watching, and Fool on.